Institutional investors. These are the type of people who chase alpha harder than Wall Street interns chase validation from their managing director, who doesn't even happen to know their name. And in recent years, these interns and the trillion-dollar funds they serve have all been obsessing over one asset class. Not stocks, not crypto, not real estate, and not even artificial intelligence. Nope. It's an industry that's grown tenfold since 2007, has quietly cranked out a new wave of billionaires, and is so dull sounding it makes municipal bonds look sexy. It's private credit. That's right. The most boring sounding corner of finance has quietly ballooned into a more than $2.5 trillion juggernaut. For context, that makes the global private credit market bigger than Canada's GDP. But let's be honest, that doesn't really count for too much anyway. And here's the kicker. Private credit has delivered nearly identical returns to the stock market over the last 20 years, but with far less volatility. It's stock-like gains without the constant stock-like mood swings. So if private credit is so great, why does nobody outside Wall Street seem to know about it? That question is why I launched a 2-month investigation into this secret industry that's quietly taking over Wall Street. You've probably heard about private credit from some zin-slinging finance bro. You know the type. Patagonia vest, Red Bull in hand, and a nicotine pouch lodged so deep it's basically part of his personality. But in case you haven't heard of private credit before, here's the gist. Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank, dap up some banker named Tucker, and boom, you had a loan. No questions and no stress. Tucker didn't care about your credit score, verifying your income, or the fact that your last company was literally a failed vape shop. Back then, loans were handed out faster than rashes on spring break. And surprise, surprise, that's how the financial system ended up with a hangover so bad it nearly killed the global economy. And as a result, after the 2008 financial crisis, everything changed. Banks turned into strict parents, and they got a whole new set of rules and regulations. Nowadays, when you walk into a bank, you beg for a loan, fill out 50 forms, offer your firstborn as collateral, and maybe, just maybe, they'll give you money. And that's where private credit steps in. Private credit is like the sketchy uncle who says, "Don't worry about that report card. I'll give you cash right now, but you might not like the interest rate." And boom, that's private credit in a nutshell. Instead of going to a bank, companies borrow from non-bank lenders like Blackstone, Apollo, or Ares. These firms cut direct loans, charge higher rates, and make strong returns. It's kind of like Venmo, except your buddy isn't sending you $20 for pizza. He's wiring $200 million to a mid-market oil refinery so it doesn't go bankrupt. So why is private credit working so well? Because finance, like your ex, follows one rule. If there's a hole, someone's going to fill it. But before I jump into how private credit plugs a hole in the market, let's back up for a second. In the early 2000s, the private credit market was small, about $140 billion globally. It was the weird sibling of private equity, still niche and still ignored. Then came 2008. Over the years, banks had been handing out loans like candy on Halloween. It started with the infamous ninja loans, which were loans to people with no income, no job, and no assets. Then banks started bundling these steaming piles of debt into collateralized debt obligations, or CDOs, and were selling these as securitized products. And if that wasn't reckless enough, they invented CDO squared, which was essentially just ticking time bombs disguised as investment products. And shocker, it all came crashing down. The banks had blown up the economy by handing out loans to anyone with a pulse. So following the financial crisis, regulators stepped in and said, "It's time we start acting like responsible adults." These regulators rolled out a whole new rulebook that forced banks to increase capital reserves, cut leverage, and tighten lending standards. This meant that lending to small and medium-sized companies, which were the companies with higher risk profiles, suddenly wasn't worth the headache for traditional banks anymore. And so by 2010, traditional bank lending to these middle market companies had plummeted. But here's the problem, these middle market companies still need money. And now they were in an awkward spot. These middle market companies were too big for your local community banks, and too small to issue bonds on Wall Street. And that's where private credit steps in. Private credit funds stepped in and said, "Don't worry, the banks may have ghosted you, but we've got you. Forget the collateral. Just sign here, pay 10% interest, and we'll tack on a few fees." and companies lined up faster than white girls at a Lululemon sale. In 2010, private credit assets under management sat around $300 billion, and by 2020, this number had surpassed $1 trillion. That means since 2007, private credit hasn't just grown, it's exploded more than tenfold. It's turned from what was once a niche corner of finance into Wall Street's favorite money machine. Over the last 20 years, private credit has returned about 9.6% annually, while over the same period, the stock market has returned about 10.2% annually. So if private credit has underperformed when compared to the stock market, why are investors drooling over this asset class? And the answer comes down to two words. Two words that make business majors whisper, "This is it, boys." Two words that make that girl a couple desks over from you say, "Maybe he's not such a nerd." Two words that make investors salivate just at the thought. And the two words are stable returns. See, while private credit may trail the stock market by about 60 basis points annually, it delivers those returns without the emotional roller coaster that stocks bring. Stocks can swing 20% up or down in a single year, or a single week if Jerome Powell so much as clears his throat, while private credit, on the other hand, is smooth, boring, and consistent. And after over a decade of interest rates being garbage, where bonds paid next to nothing, private credit has become the Goldilocks asset. Too risky for banks, too safe for hedge funds, and just right for anyone managing $30 trillion in other people's money. It offers pension funds and endowments a place to park their $30 trillion in assets under management. It's a seemingly perfect middle ground solution with equity-like returns and bond-like volatility. However, it's not all sunshine and rainbows. Because while on the surface, private credit may sound like the perfect investment vehicle, it carries its own set of risks, specifically around liquidity, mark-to-market valuations, defaults, and leverage. When it comes to private credit, there's no centralized exchange, no liquidity, no public price quotes, and nobody really knows how much these loans are worth until someone stops paying. And even then, it's kind of just a guessing game. But that's the magic of Wall Street. Investors will happily ignore any growing cracks underneath the surface as long as they're getting their 8 to 10% a year. Because the whole private credit industry is run on one assumption: borrowers will keep paying. And to be fair, for the last decade, well, they have. So yeah, maybe private credit really is Wall Street's hottest new industry. Or maybe it's not. Maybe it's just the latest bubble wearing a different colored suit. The truth is, nobody knows and only time will tell. But for now, Wall Street's getting richer, and that's all that really matters. And as long as those interest payments keep rolling in, nobody's going to be asking too many questions. So for now, the story keeps going, money keeps flowing, and we can all keep pretending the music will never